we were in negotiations.
Investing in real estate, they're winning, they're making money.
Welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I am your host, Kevin Amolsch. This is one of the best podcasts that we do because we're talking about the market pulse. What is going on in your backyard? Obviously, we do lots of business in Denver and Minnesota. This episode, we're digging into the Denver market. And I think we're going to go a little bit beyond that because right before we hit record, we were talking about the election and what impact we can expect on the market. So let me introduce my first co-host, who's always here for the Market Pulse, Mr. Justin Cooper. What's up, Justin?
How are you, Kevin? Good to see you.
Good, man. I'm doing really well. How are you doing?
I'm doing pretty well.
Awesome. And then Mr. Joe Massey, our local expert, is going to be digging into some of the statistics. Joe, what's up, man?
Howdy, gents. Always appreciate you guys having me on. Always appreciate the opportunity to talk to your audience, and just excited to chat with you guys. We don't do this often enough, and so I appreciate you guys making the time today.
Yeah, we're pretty busy over here at Pine, Joe. So we're about a month off of when we maybe should have released this, but that's good because a lot of things have changed in that last month. So it's going to be even more current information. And I'm writing an article now about the relationship between the Fed funds rate and interest rates on 30-year fix. So that's going to come out in the next newsletter. So I want to get into the interest rates a little bit with you. I want to get into Denver statistics, and I want to get into what's going to happen, not in the election, but what's going to happen to the markets regardless of what happens in the election. So what do you think, man? Where do we start?
A big question that we get from basically 2 weeks ago until the presidential election, Joe, what is going to happen with the housing market and what is going to happen with interest rates with the upcoming election? And so we went through and we did some studies, and number one, on home sales. Elections don't really have a long-term impact on home sales. It mostly slows down the sales count in November, but those delayed sales are recovered over just the next couple of months. So we went back and did a statistical analysis on the last, 13 presidential elections. And what you find is that in an average year with no presidential election, sales from October into November declined by about 9.8%, which makes sense seasonally, right? People always do less in November, Thanksgiving, holidays, school, sports, all of that. What happens in presidential election years? From October until November, sales slow down by 15%. So if you're trying to sell your home sometime between now and the end of the year, don't do it in November because there's not going to be as much traffic out there. There's just a lot of people that really hit the pause button.
Now,
what happens?
I don't mean to interrupt you, so I apologize for that, but I don't want this to get away. Is this Denver specific, or are we talking a national statistic here?
This is a national statistic. So everything that we looked at for answering the questions on how do elections impact the housing market and interest rates, we did do on a national basis.
Got it. Okay.
I think we could extrapolate that to Denver, but I did not go into Denver specific stats over the last 13 elections.
Gotcha.
Now, what happens though, because you say, man, an additional 5% slowdown in home sales, that's got to make an impact. Prices should be going down. Well, it's important to remember that's just 1 month. What happens in the year after the election? In 9 of the last 11 presidential elections, there was an increasing number of sales in the following year. And I expect that's going to be true this year because we have depressed sales count for a number of reasons, which we can talk about. And just about all metrics are showing that 2025 is going to be a better year. And here's a really important point, regardless of who wins the election, right? I think that's a really important point that I want to make, and I imagine you guys feel the same. We're not endorsing anybody. We're not saying you should look at this side or that side. This is just what happens regardless of who wins. So I think that's a really important point. There will be a slowdown leading up to the election, but we're going to recover probably by January or February and have the same number of sales count in nationwide homes and most likely increasing sales count next year. What do you guys think about that?
You know, I was trying to dig into what we're looking at here for the listener is the election year and how many homes sold. And then right next to it is Joe calls it year after, and how many homes sold. And you can see the little arrows going up or down. And I was trying to make a correlation because the only two on here that sales went down were in the 80s. And if you remember back to the 80s, that's when the savings and loan crisis was running wild, and we were definitely high inflation, like way higher than what we saw this last cycle. And then interest rates in some areas hit like 20%, right? 16 to 18% was sort of the norm during this time. So I'm wondering if there was any correlation there. So that's what I'm thinking.
Yeah. So I also did, so this graph is showing home sales. We also did a study, which you guys can watch the full video. I'll put the notes in for you guys. It's on my website at loansbyjoemassey.com. And we did a full statistical analysis, and you see that over a 180-day election cycle, greater than 75% of the time, interest rates decline. And they go down by an average of about half a point.
Got it.
But roughly 24% of that 180-day cycle, interest rates go up, but they increase by about 1.5%. But there's really no major correlation on interest rates always go up, always go down. And we've got a pretty big sample size. So the answer, in my opinion, should you wait if you want to buy a home or investment property? Should you wait until after the election? Probably not. I don't think that it really makes an impact. I think you need to buy investment properties, buy your primary residence. It makes sense for you, and not try to time the market, because there's no significant correlation other than if you're really thinking about buying a property. November might be a good time because there might be a lot less traffic. And if you're thinking about selling a property, November might be a really bad time because there will be a lot less traffic.
Yeah, that is interesting. And I always think that it doesn't matter because there's
Mhm.
a lot less inventory also. People aren't putting their houses on. So yeah, less demand, but you also have less inventory. But I've never actually looked at the statistics, so I don't know if that's true or not.
Yeah, I don't know. I know anecdotally, I have a couple of my investors that they only shop for houses in November, because anybody that has their home listed at Thanksgiving needs to sell it. And so they buy one or two properties every year. They go under contract like Black Friday and close before Christmas, and they get really good deals compared to the rest of the year. Now, that's just their investment methodology. That's the only time they look at it. Then they finish up the property, rent it out, etc. And that's just the cycle that they work in, and they feel really happy with that. But I don't have broad enough statistics to say that that's the right time to buy a property.
What do you think, Coop?
Couple thoughts here. I agree with what Joe was just saying about how he's got some investor clients that are only buying, at the end of the year. At Pine Financial, we only lend to real estate investors, and so we always think, okay, the year's coming to an end. We start kind of thinking we're gonna slow down a little bit and enjoy the holidays, and inevitably, it's always our busiest time of the year, potentially for the same reason, because investors think that's when they're going to get good deals. They're trying to ramp up, buy at the end of the year, and be ready to sell in the spring. So we also see that our investor clients go on buying sprees at the end of the year. But I love the slide that we have up here because we all know it. We all feel that election years get a little slower, and you guys actually did the diligence, put the pencil to paper, and really showed just how much. And nobody ever really talks about just the fact that there's a slowdown around the election time. But then when do we make that up? And you guys show that we actually make it up and come back to even within just a couple months after the election. I think that's really important because everybody only really thinks about the slowdown at the time of the election, but we even out very soon after.
Absolutely. And I think it's an important question because a lot of people talk about it, right? A lot of people say, I want to see what's going to happen. So it gets into our psyche, but the real answer is it doesn't do much other than just paralyze some folks that are really focused on it.
Yeah, I was just going to ask Coop to elaborate a little bit. So if you're an investor, you own a bunch of properties, you're always looking. If you now you know this statistic and you're looking at a 5-ish% further decline than normal, what does that mean to you as an investor?
It just means that there's going to be less competition out there, right? So it certainly means put on my buying hat and get out there, right? I mean, we're not going to see any big changes with lending. We're not going to see any big changes with interest rates necessarily. So if I have a good foundation of what I'm looking to buy, then I know I can go out there and look, and I probably have to make fewer offers. Um, I could potentially offer a lower purchase price because there's less people out there competing. I'm not worried about being one of five offers on the property I'm looking at. So my likelihood of getting a property is higher than potentially the rest of the year, and certainly higher than every 4 years. So yeah, if we're really looking to buy something this year, how many how many investors do we talk to who are like, oh, we're going to buy so many properties by the end of the year? Well, look at the end of the year, right? Don't give up here just because it's August or September. Stay in the game. Don't get frustrated, and you might actually be able to buy a couple more properties in November.
Good. Cool. What else you got for us, Joe?
Let's see other topics on this. So um, we've got a slide here that talks about an election year does not alter the price trend that is already happening in the market. And so on the left-hand side, you see existing homes, and on the right-hand side, we've got new homes. And we went back to the early 90s just so this slide was a little bit more readable. And what you see is if home prices are increasing in an election year, they generally tend to increase the year following. The exception to that would be 2008 going into 2009. I don't think the election impacted that. The big thing that impacted that was the global financial crisis, right? The Great Recession. But by and large, if home prices are increasing during the election year, they tend to continue to increase after the election year, with that one exception. So if you're thinking, hey, the election is going to swing things one direction or the other, I don't see it. I don't see that there's going to be any direct correlation there.
Yeah, and I guess I would expect this. I know there's a lot of fear around an election. There is every single time. And everyone says, well, especially this year, this one's really scary, right? But they say that every single year. Um, the truth is that there's not a big impact. How do I say this? It's not like the president goes out and makes a law, and then the next year we're getting like everything's changed, right? There's
Right.
still checks and balances. There's still processes. There's still branches of government. So I just don't. I guess I just don't buy into all that.
I completely agree. And that's what the stats show. And the stats show there's very minimal correlation. Um, and so if you're an investor listening to this, buy properties when it's right for you and your personal situation. And a really important quip that I've learned is time in market is more important than time of market. Meaning, buy a property, hold it for a long period of time, or buy a number of properties, hold them for a long period of time. That is where you're going to make a heck of a lot more money versus potentially buying on exactly the right day, which is really, really difficult to do.
I love that.
Mhm.
I don't think I've ever heard that before.
Very last one I've got for you. Mortgage rates decreased leading up to decreased leading up to 8 of the last 11 presidential elections. And what you see is in 1980, 1992, and 2016, interest rates increased for that 6 months leading up to the election. And then again, I did a much deeper analysis that you guys can watch on my website that goes into the 90 days leading up to the election, the 90 days after the election, what happens 77% of the time. Interest rates go down over that 180-day period, but they only go down on average 0.5%. But that 23% of the time that rates go up, they go up by a full 1.5. So there's a lot more risk on the
Oh,
upside
interesting.
if interest rates go up versus benefit on the downside if interest rates go down. And in this cycle, we are, what are we, 15 days into, this 90-day presidential election cycle. We are seeing interest rates slightly declining as we're going into this cycle, which I know we're going to touch on that a little bit. So it looks like, this is going to be one of the 77% of the time that interest rates might be lower, 160 days from today.
Yeah, I think we even talked about that on the last Markets Pulse podcast with the real estate educators. We talked about the projections of interest rates, and by and large, the experts were saying, and these are like the big boys, right? Wells Fargo, who else was it? Mortgage Bankers Association. In fact, I have it right here, and Fannie Mae. So those three. And by and large, it was all around 6.5% by the end of the year. And I'm looking at the graph right now, and it's still right around that as a projection.
Mhm. Which interestingly, guess what interest rates are at today?
I'm guessing they're right around that, and they were.
Right around 6.5%.
Right. So if this plays out, we won't see much movement in rates through the year.
I agree.
That's interesting. I mean, I'm not trying to jump ahead of what you want to present here, Joe, but maybe we get into the interest rates because
Let's talk about it.
now I'm hearing that the Fed might lower rates 3 times. There's 3 meetings left in the year,
Hmm.
right? September, November, and December. And if they could potentially lower in all 3 meetings and still hit their original projection of 3 cuts this year.
Hmm.
How do you keep rates around 6.5 when the Fed's cutting like crazy?
Well, I think what you pointed out is they might do that. And here's two historical facts about the Federal Reserve. And you guys know I have a degree in economics, studied the Federal Reserve and all sorts of macroeconomics for a long period of time. Two historical facts. Number one, they are always late to the game. And number two, they always overreact. If you go back and look at every single
No.
economic cycle, those two facts are always true. They're late and they overreact. So I think we can all agree that maybe cutting interest rates 3 months ago by maybe just 0.25% might have led to some stability in the market. But what are they doing? Waiting for inflation to come down. And part of that is where we're at now, which I think we're going to talk about, is inflation is beginning to cool, beginning to slow down. And we might be into September, maybe even the October or November meeting before they cut interest rates. And will they overreact? I don't know. Maybe. But they are trying to engineer a soft landing, which seems like it might be working. We have not entered a recession that if you go back 2 or 3 of these episodes from, 6, 9, 12 months ago, we were pretty agreeable that we would be in a recession by now. And it doesn't appear that that's happened. So I might have to take back one day all my negative talk about the Federal Reserve. They might actually be getting it right this time. But historically, they're late and they overreact. And we're just going to have to see if that happens this time.
Yeah, I'd like to go back and listen to what we said 6 months ago or 7.5 based on our actual cadence here.
I'll bet we
Because
sounded really smart.
I don't, I mean, I'm clearly, um, I don't know that we were projected recession. I actually think maybe I said we were already in a recession or already through it.
Mhm.
And I still believe that. Housing prices did dip. Gosh, I might get this wrong here, but it was significant, like 9% or something from peak to trough.
Mhm.
That's like recession, right? Although recessions don't usually hit housing. Two of the
Right.
last 9, they didn't impact housing in any meaningful way. 1990 and 2008 were the two. But
Right.
I could tell you
And
that it
I'd like
dropped
to,
recently with interest rates going up. Housing values dropped recently more than they have in 7 of the last 9 recessions.
yeah. And I'd like to add something to that. What you said is, a 9% decrease, that's a recession. I want to disagree with you. That's a housing recession. Because what we may actually be in, I read a really good article, a rolling recession where certain industries are in recessions at different times. And so the entire economy doesn't go into a recession. So anybody that's listening that's in the housing market, that's a real estate agent, a lender, you know, you might be saying, we've got to be in a recession because my transaction count is down 70%. Well, it's very possible that we are in a housing recession. Actually, I think we would all agree on that. We're in a housing recession. We're the first ones that went in. We may be the first ones to come out. And then there may be a recession on the service-based sector. There may be a recession on industrial and manufacturing, but those might trail. And as long as those don't all line up, the entire economy may not be in a recession at the same time. It might be a rolling recession through various parts of the economy.
Yeah, I mean, I 100% agree with you. And I'll caveat by saying what is a recession because I'll tell you what the government doesn't even know. Like you could look at the official definition of a recession and it is vague as shit. It doesn't tell you what. Now we learned in
Hmm.
school, Joe, that 2 quarters of negative GDP is a recession. We've had that. Okay, we've had
That's right.
inverted yield
We've
curves.
had that. And they
That's the
said, no, no,
number
but we're not in
one
a recession.
indicator. The number one indicator for recession
Yep.
outside of GDP is a negative yield curve. We've already been in and out of negative yield curves. And we're still not saying a recession. And I think the reason is unemployment. The unemployment is ridiculously low. Now it popped, which shook the market, right? 4.3 now. It went from 4.1 to 4.3. And everyone freaked out. Emergency cuts, right, is what we were hearing. And 4.3% unemployment is still low.
Mm-hmm. I think
know
you're
where to
exactly
go with
right. It's a debatable comment on, are we in a recession, and more important than what you said, what's the definition of a recession? Nobody can even agree.
Why? I mean, I'm going to look it up while you're sharing your next slide, and I'm going to tell you what the definition is, okay? And then we could laugh about it, and then we'll
Well,
move on.
yeah. Do you want to talk a little bit about inventory, and what is happening with inventory and price cuts? So a lot of the time, and Cooper, let me ask you, we're still seeing home prices increasing in most markets. What do you think that is? Interest rates are high. We're hearing all about buyers on the sidelines, but we're still seeing prices go up, not at 20% a year, but at 3%, 2%, 5%, 6%, depending on markets. Why do you think that is, Coop?
Yeah, I think it comes down to a supply and demand issue. And a lot of people are
Mhm.
raising that flag of supply is skyrocketing, right? We're having more properties on the MLS. They're sitting there longer, um, but it's still not enough. It's still not a balanced market. And so once we hit that equilibrium, that's when we'll see the prices level off. That's what we'll see. And I think we're not there yet. And I think that's probably what's going on.
I think you're exactly right. Why are prices not declining? Because there is a lack of inventory. Now, we might say, but you know what, Joe? Inventory went from 0.6 months to now we're at 2.2 months here, I think, in Denver. And nationally, I think we're up to maybe 3 or maybe 3.5 months of inventory. But on the slide we've got here, if you go back to 2017, which was 7 years ago, pre-COVID, the inventory nationwide was 1.2 million homes. Then in 2021, inventory drops to 400,000. And now inventory has increased to over 700,000. And so people say, wow, there's 300,000 homes on the market. That's an 80% increase. Prices have to be coming down. Not really, because we're still not even back to the pre-COVID numbers in 2019, 18, or 17. So yes, inventory is increasing, but it is still a lacking number compared to where we were at in a more healthy market like we had in 15, 16, and 17. So home prices are continuing to go up simply because there's not enough homes on the market. Now we're seeing more, and we may get back to a more balanced market. But if interest rates go down, which Kevin touched on, I think that inventory is going to get gobbled up pretty quickly, and we may stay in more of a seller's market. Hopefully not an absolute, frenzied seller's market like we had, but I see a lot of positive for people that already own real estate, that home prices are likely to continue to go up.
Yeah, exactly. I think we might be seeing the signs of the election slowdown happening already, right? And that's why
Hmm.
inventory is creeping up. It could be something else, right? I mean, we'll continue to track it and see it, and there'll continue to be headlines about it. But with this increasing inventory, it just hasn't increased enough um, to really affect prices yet.
Yeah.
Yeah, I want to make
And
sure it's
on that,
clear what I said about the home price decline because you're showing us statistics now. There, it's actually increasing in value. So I want to point out that I agree. It is going up in value now. So it dropped and it recovered, and then it's been going up. So I said from the peak to the trough has been a pretty significant decline. But I agree
Mhm.
100% that prices are going up because of the inventory issue. And your slide, if you want to go back to that real quick, Joe, you're showing from 2017. I'm looking at a graph right now from 1983, and you could see very clearly on this graph, average is between 1.8 and 2.4. Okay, and it
Mhm.
spiked in 2008 and through until about 2013, and then it went way, way down, and it has not recovered. But
Yeah.
average long term is somewhere just eyeballing it here between 1.8 and 2.4
Hmm.
Yeah. Number of listings.
number of listings. Yeah. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
So the last thing I want to touch on inventory is we are seeing price decreases. And I don't mean value decrease, right? We're not talking about a property is valued at $500,000 and now it's only worth $450,000. We're talking about listing price. Property is being listed at $550,000, and we are seeing that a very high percentage of sellers are decreasing the price they're asking for the property. That doesn't mean the value is going down. It means they listed it at too overzealous of a price. And we are seeing, as much as 6% of listings experience a price drop per week. So for those watching, we've got kind of a busy chart, but you are seeing that our most recent data from May showed that 6% of listings were dropping their price every single week. And that is higher than we've had at any point in the last 4 years. So it doesn't mean that values are decreasing, but it does mean sellers are realizing, hey, I can't list my home $50,000 above and expect to get 10 offers. I may actually have to work with buyers, which for those of you thinking about buying real estate right now, whether you're an investor or a primary resident buyer, this can be a really good time because sellers still have it in their mind, I'm going to list the home and have 10 offers and sell it for a premium. And when they get to day 30 and they've only had 6 showings, they start to panic. And you can get price reductions, you can get things fixed on inspection, you could even get seller concessions, which can make a really big impact to that interest rate that you're going to pay over the near term.
All right, I got my my definition ready for you guys. You guys
Can't
ready
wait
for
to hear this.
Okay, this comes, fact check this if you want, listeners. The National Bureau of Economic Research, they're the ones that actually identify and announce recessions, right? And we know they always announce it after it's happened. You don't know it while you're in the store, but it's only after you get out then they say, yeah, you were in that. So the official definition is a significant decline in economic activity that is spread across the economy and that lasts more than a few months.
Could that be any more vague?
Yeah,
That's
how
the
do you define
official
significant.
That's the official definition of a recession, a significant decline in economic activity. What economic activity? As Justin said, what's significant that spreads across the economy and that lasts more than a few months? So how many months?
How many is a few?
It
Is that
doesn't, none
2?
of this makes any, it doesn't, they don't know. But this is all by design because they don't want to, they want flexibility of when to say it's a recession or not. Right.
Mm-hmm. Yeah. Like few can be very vague. Like, how many drinks did you have? A few.
It's always just
I
a
mean,
few.
for me, that's 2. For Justin, that's 7. Right? Like that it depends on who you're asking.
I'm only at 6 right now, so
And then I have I know we want to get into some Denver stuff if you have it, Joe, but I have some, I think it's some recent statistics on months of inventory. So we know we all love months of inventory because it tracks absorption and, oh, do you have that? Absorption
Not-
and the inventory level. So how many months will it take to go through all the current inventory? Nationally, we're at 4.1, which is actually pretty average. I mean, we're getting to the point now where there's no advantage, seller or buyer. Now, people will disagree with me on this. I hear people say all the time, 6 months of inventory is a neutral market. I'm telling you, it's not. It's between 4 and 5. Okay.
Yeah.
Nationally, we're at 4.1. Denver still a seller's market, 3.2 months.
Yeah. And I think you're exactly right. 6 months of inventory is not a balanced market. 6 months of inventory is probably going to be on the buy side, particularly
agree.
since our perception is so skewed because we've been in a frenzied seller's market for greater than 10 years. I mean, I remember when we entered a seller's market, it was March of 2012 when we went back and looked, and we've been in the seller's market since that time. And so now, if you get to 3, 4 months of inventory, that's not 6 months, but that is very much a balanced market when it comes to consumer behavior, right? Because you have a seller who's nervous about selling, you have a buyer who feels like they've got the upper hand. 4 months is very much of a balanced market, and we are approaching that number. And I have a slide here that is also a busy chart, but shows the showings per active listing. And if you look down at the very bottom, the blue line shows showings per active listing in 2024. And in July, we were just over 5 showings per listing. And that is the lowest that we've had in the last 7 years. So we have not even gotten back to the pre-COVID numbers of 2017, where we were showing 7 or 8 times per active listing per property. So what that means is you have a lot of sellers that are not getting nearly as many showings as they got last year or the year before, and they're a little bit panicked. So again, for buyers, could be a really good opportunity.
So again, we're looking at national trends here.
This is actually a Denver trend. This is a Denver from the 29
Okay.
cities that make up the Denver metro area.
Gotcha.
And I didn't bring a bunch of Denver slides, unfortunately, so I apologize for that. But this is a local Denver slide.
Oop, what are you seeing with your clients in Denver?
Um, well, a lot of fix and flips, and so a lot of clients are out there trying to buy fix and flips. I mean, Prime Financial is, I mean, slammed, which is such a good problem. With folks trying to be buying investment properties, but when we're talking to folks that have bought properties earlier in the year and they're selling them, they're definitely seeing days on market are much longer. I was actually just talking to someone who has a property in Fort Collins, and they held it way longer than they thought, but they actually got a contract higher than they thought as well. So
Mm.
it's an interesting mix right there, right? Their holding costs and their days on market are much higher, but the purchase price was still very, very high, or their sell price was still very high. Um, you would think if somebody's holding a property very long, they would be dropping their price, just like we've kind of been talking about a little bit, but they have not. They did not have to do that. They still got a buyer. Um, Either at or above actually what they were asking for the property. So, kudos to them for holding on and holding strong and just waiting for that right buyer. And I think a lot of folks are not doing that, especially on the retail side. They're not waiting for that right buyer, whether that's because expectations weren't set or because maybe they're in a more desperate situation. But um, I think if we just hold on, where sellers were to just hold on and wait longer, they could probably get the price that they're looking for. It's just taking longer to get there.
Yeah, so I just pulled up the Denver County. This comes from the Realtor Board. Um, Months of inventory in Denver as of July 3.1. And to Coop's point, days on market 29. So that's up almost 40% from a year ago.
Mhm.
So days on market is extending. Months of inventory is going up. Inventory is going up, which normally you would see the reverse of that. No, that's not true. It's all going in the same direction. And what are we seeing here? Median home values. So values almost exactly the same. It's like been very stable. In Denver County, it's gone up 0.5% over the last year.
Mhm.
Yeah, I think it'll be interesting. There's all these moving parts, and then when we factor in the election, we won't really be able to see if all the stats that we've been talking about actually play out until probably next summer. Because we can already potentially feel the slowdown happening right now, and that's obvious with the inventory going up and the days on market going up. That could be the election. It could be something else. And we're not going to necessarily see that rebound and bounce back up until the spring. So, our Q2 or end of Q1 update may not show all those numbers. So we may not be able to be back on here until next summer to actually see how all of this shakes out. So I'm actually pretty excited to see how this shakes out because we're talking about so many interesting things just related to so many different moving parts, the economy, what the Fed's doing, unemployment, but also the election. And I'm actually like, I guess I don't usually get excited about all these types of things, but I'm actually excited to see how all this will shake out over the next, 180 days, 200 plus days.
Yeah, and I'm this is making me think like, how can we help our listener in Denver right now? Investor in Denver, how do we help them with all of this information? And I could tell you, I'll tell both you, Joe and Coop, what I'm seeing is our clients are listing properties higher than they were worth when we did the loan for them. And I think that's a big issue. So I just told you the value didn't go up. Okay.
Hmm.
I have the statistics right here. I'm looking at it. Um, Yet we're listing it for higher than it was worth back then. So why are we doing that, and what damage does that cause? What do you guys think?
Well, the damage that it causes is you're going to have higher holding costs, right? If you list a property too high and you've got financing on it, or even if you paid cash, you have higher holding costs or a loss of opportunity cost. And a lot of people get married to a price because that's how much I need to make money. And then every month they're making a $3,000, $4,000, $5,000 a month payment, and that's eating into their profits. And then finally they say, okay, I've got to decrease my price, and it still takes a while. So I think they're harming themselves. There is very little danger, and this is an example I use. There's very little danger of underlisting a property. If I were to list a property for $1, how many people are going to go look at it, and how many people are going to bid on it if I list it and say it's for sale for $1? Will I get a lot of traffic?
I actually have no idea. I think so.
I feel like it's a trick question. At $1, yeah, there'd be a lot of calls saying you messed up. But yeah, I mean, all the traffic, right? Everybody's
Right?
interested. Why is this property $1? I can afford $1, right? Does it need repairs? Does it not? You're going to generate
And,
a
but,
ton of traffic.
and what's it theoretically going to happen? It's theoretically going to get bid up to approximately the market value, the highest price that somebody's going to pay. But what happens if I list that same home, and let's say if I list it at $1, it goes to 500,000, and I sell it and I'm thrilled. What happens if I list it at 575? I might not get a lot of traffic because a lot of people are going to look at it and say, "Oh, it's only worth 500." They're not going to come down $75,000. And now I have a stale property that sits out there for a while. So there's a lot of danger in listing a property too high, in my opinion, and I'm not a real estate agent. There's not a lot of danger in listing a property too low, because if it's too low, everyone's going to see it, it's going to get bid up, and it's going to sell right at the market price. If it's too high, you may sit on it for a while, and you're going to have to be going down in price, and you may sell below the market value due to just unfortunate pricing. So, in my opinion, if you're selling a property right now, I would be really cautious about listing it for too high of a price compared to your comparables.
You agree, Coop?
Oh, 100%. I mean, that's the risk is your holding costs. Um, your profitability going down because you're shelling out more money to hold the property longer.
Yeah.
100%.
Yeah, I agree with that. And just to elaborate, Joe, on what you're saying, I 100% agree that the reality in real estate is perception is reality. And if the
Yeah.
perceived value isn't 500, even though it is worth 500, you're not going to get 500, right? I mean, to in large part, it's an open market. Now that I joke all the time that it's not a free market because appraisers screw it up, but I do think that you have to have a willing buyer and seller. And if you list it too high and then you start coming down and down and down, we know months of inventory has shot up. It was under a month for a long time, and now we're 3, right?
Right.
3.2, 3.1, whatever it is. Um, it's 3.1 in single family homes. I'm going to be very clear because I'm not bouncing around here. It's 3.1 right now in Denver for detached single family homes. Okay, so we know that months of inventory has gone up. So why are we going to push the value? All it's going to do is make us lower it, lower it, lower it, and then all of a sudden we're under what it actually was worth because the perception is something's wrong with the house.
That's right. That's right. Can I touch on a couple things that I do? Because you asked, how can we help our listeners? Can I touch on a couple of specifics that I do?
Please, yeah, please.
Yeah. So, one thing that we do right now is for any primary residence buyer that purchases a home with us, we give them a free 1-year buy down. So, let's say they qualify for an interest rate today of 6.5%. We give them a rate of 5.5% for the first year. That allows them to have a little bit of a lower interest rate for the first 12 months. They also get a voucher that they can refinance at any point in the future whenever interest rates go down. So if a year from now, 3 years, 5 years from now, or 6 months from now, interest rates go down to 5% or 5.25% or whatever, they can refinance with no closing costs. Now, for sellers on the call, here's how you can use that. Number one, I think seller concessions are a really powerful thing. But if you don't want to offer seller concessions because you're worried about your profit margin, you can list us as your preferred lender, just exactly the way that new build lenders do that. We'll still offer that buyer a free 1-year rate reduction, and we will still offer them a free refinance voucher so they can refinance at any point in the future. So we've been using that program, or those two programs combined, to help a lot of buyers get off the fence and help fix and flip sellers get their properties marketed and sold at a current value, but the buyer is able to take advantage of a lower rate and the opportunity to refinance and renegotiate that rate for free whenever they decide it's a good time to do that.
It's awesome. Thank you for doing that.
Yeah,
I do. I
I
tell
hope it
people
helps your
whenever,
listeners.
yeah, whenever someone asks me why Joe, and I mean, there's tons of reasons. Obviously, you do what you say and all these things, but this is another reason why you really do stand behind what you do.
Thanks, Kevin. I appreciate that.
The interesting thing that I hear Joe saying is that he's communicating with his clients, right? He's talking to them through the process and offering them solutions and making them aware of what could potentially be happening. And I think that's what us, Kevin and I at Pine Financial, as well as real estate agents, need to be doing in this market, managing expectations, having these conversations.
Yeah.
I was talking with somebody who's trying to go under contract on a property, and the seller is holding strong, at over 700,000, and my investor is looking at buying around 650,000. And we're talking about, well, maybe there's some new listings coming up, maybe we could do this. And I'm like, yeah, I mean, those sound like good comps. Or you can trust your gut, your original instinct, which said, in this case, you're not going to sell it for more than $1 million, because we are going into an election. We are going into the end of the year. We are having all these things come up. And so, do you want to get aggressive and then what, potentially lose money or break even? Or do you want to trust your gut and go in a little lower? And maybe, that property hasn't sold in 4 months, is probably not going to go under contract this weekend. So, stick to your guns. How does that feel? And having these conversations about how to approach these things. And I think in a similar fashion, real estate agents are also having more conversations. I know we don't necessarily need to or want to go down too much of a path here about the NAR settlement, but that's exactly what is happening with real estate agents, right? They're having to communicate a lot more with their agents. And I think all of the stuff we're talking about here, all of the value that Joe adds, good real estate agents should be having those discussions as well as part of, also talking about buyers' compensation and how we're going to negotiate that. All of these other things are really important to talk to their buyers and sellers about.
I agree.
Yeah, I 100% agree. Thank you for that, Coop. I just wanted to show this. You see the big drop and then how it's recovered. So
Mhm.
this is what I was talking about. And that might be that the housing recession, as Joe mentioned. While I got this up, I also wanted to show you if I could.
Well, as
Can
you're
I
looking,
pause you for one
that's an
second?
interesting note right there. From peak to trough, we are now back to that same peak, it looks like.
Yep.
Yeah,
That's exactly what I was going to point out. Is so many people are like, "Well, I'm going to wait until home prices drop and then I'm going to buy a house." Missed it, brother. Home prices
Yeah.
already did drop.
yeah.
All
You
and
you
fully
missed your
recovered.
time. If you're trying to time it perfectly, which none of us would recommend, you've already missed it. Current rates. This is the current federal funds rate, 525 to
Mhm.
550. It bounces around in that range. After the meeting, they're expecting 77% chance it's going to be 500 to 525. That's 5 to 5.25%. So these are in basis points.
Mhm.
Or there's a 23% chance it's going to be two, like quarter point, so a whole half a point uh, reduction. So 23 and 77, they're expecting a 100% chance of a rate cut in September. The question is it a half a point or a quarter point? Right? I thought that was interesting, and that's because of those unemployment numbers that came out.
Here's my question for this. I have not seen this, but I'm going to have to go download this. Who is they? Who's
So it's a survey of uh, economists, I believe. I think there
okay?
was like 30 economists or something.
Okay. Cool. This is a really neat tool. I've never seen this.
Yeah, and you can just look, so what's going to happen in November, right? And these are just projections, right? And this thing changes every day,
Hmm.
so I don't put a ton of weight on it. But
Yeah.
I have noticed that now the half point and quarter point have been moving a lot, but the 100% chance of cut has been very consistent.
Yeah.
And then you can see they're expecting another cut in November and then again in December. December less likely. I mean, there's still a good chance it's going to be between 4.25 and 4.75. That's the
Hmm.
most likely outcome. So we'll see.
Very interesting.
All right, what else before we wrap up? Anything, Joe?
No, as
Tell me something
always, I'm
good.
really grateful for the time. You guys are just phenomenal business partners. Anybody that has not worked with Pine Financial, I would highly encourage you to. You know, if you're a flip investor, if you're thinking about buying a rental, if you'd like to invest your own personal funds in hard money, I have done transactions with Justin and with Kevin for like 100 years, and I just highly recommend you guys. You know, so if I can just shamelessly tell everybody how great you guys are, I want to do that. You guys do a phenomenal job, and I'm really grateful for both of you as business partners and just pillars of the community. You guys give out tons of great education, tons of free knowledge. I know a lot of people that have become really successful because of the help that the two of you have given them. And I don't think you guys get enough credit for that. And I wanted to be the one to point that out to you.
You're amazing, Joe. Yeah, I'm getting chills. Like this is. Yeah, I remember you and I met at a bar near Sloan's Lake that isn't even there anymore.
Hmm.
Was that 12, 13 years ago?
At
Maybe
least, yeah.
15. It's been a long
15,
time.
15. Ooh.
It was
And,
when we were 12 years old and we were just getting started in real estate because neither one of us are over
and we
40
were
yet.
getting a drink. It was apple juice.
That's
Yeah,
right.
exactly.
What's up, Coop?
Nothing. I'm actually just pretty excited. Summer's now, I would say, officially over because the kids are back in school. And so a lot of routines are starting to settle in. Although we're heading into this election cycle, hot and heavy, I'm really interested to see how um, everybody, and the market kind of settles in now that school has started. But we're also ramping up and getting ready for the Real Estate Investors Success Summit
Mm.
that is coming up when on November 9th, Saturday, November 9th, here in Denver, since we are mostly targeting Denver in this podcast. And so just want to make sure everybody knows to be putting that on the calendar. It is by far the best event in all of Denver. 300 to 500 attendees, all local real estate investors, all local speakers, hand-picked, 10 to 15 local vendors that three of us all use in our businesses. Keep your eye out for denveriss.com. That's where you can go and register. I don't know, tickets are under $50. I think they're like $39 for an all-day event. All education, no sales pitches. And if you haven't been there before, then turn to the person sitting next to you. I know you're probably at home on your computer, but do it anyway and ask them how the event is, because they've probably been there if they're an investor. It really is an amazing day of networking and education. So definitely put that on your calendars, and I can't wait to see you.
Yeah, that's so awesome. I'm glad that you plugged that because it is really right around the corner. We should
Mhm.
start marketing that. We haven't yet. I know I'm excited. I'm going to get the chance to speak. I didn't go. I didn't go last year because I was climbing Kilimanjaro. But I'm going to do a macroeconomic update and where is this thing going? And it's going to be right after the election. So I'm excited to do that. I mean, I want to close with this. I just showed the Fed Watch tool. So Google that if you want to see the graph that I was actually looking at, the Fed Watch tool, and 100% chance of a rate cut. But I don't think, let me rephrase that. I'm not convinced, guys, that rate cut is going to impact mortgage rates.
I agree.
And I know that confuses a lot of people, which is exactly why I'm writing the article for this newsletter. So if you get our newsletter, probably. If you don't, sign up. PineFinancialGroup.com. You can find it and sign up and learn exactly why I don't think mortgage rates will go down with the rate cut next month. With that, unless there's anything you want to say, Joe, now that he plugged the ISS.
No, sir. Thank you for having me. Always appreciate it. Anybody that's listening, feel free to check out my website, loansbyjoemassey.com. Give me a call, 303-809-7769. Thank you, Kevin.
Awesome. Coop, how do we get a hold of you?
Yeah, best way is to call the office, 303-835-4445.
All right. So, Joe, thank you so much for the hour of your time. You could be doing other things, but you chose to be here with us and help us become better investors. Coop, same thing. You could be doing anything else, although you love hanging out with us. So,
Nothing better.
no, I really appreciate you coming on. You could be doing other things as well, and you chose to be here with me and Joe. So, appreciate you. And to the listener, you also could be doing something else, and you chose to listen in. Hopefully, you got some value. Hopefully, some light bulb or something went off for you. Time to buy is still now. We missed the dip, but you'll still be profitable as long as you have a long-term horizon, or you're fixing and flipping and you're going to be in and out. Both work. So hopefully you got some out of this, and thank you for your time. And I hope you make this day a great one. See you guys. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.